All right. GAAP is built on principles. So let's talk about some of those principles. We also have assumptions, which we'll detail, and constraints. All right. So the principles. The first is the measurement principle. In my textbook, back when dinosaurs roamed the earth, it was referred to as the cost principle. All right. So the cost principle really just means that the accounting system reports on uh, what things cost, which is considered objective. An example of this is if you buy land and you pay $100,000 for a piece of land, well, that's a $100,000 asset, all right? Well, you know land typically appreciates in value. So if you've held the land for 5 years, it may now be worth $115,000. But on the accounting records, it's going to be reported at cost because cost is objective. And that's a general principle. There are some instances in which we divert from that. Those typically for this class we won't have to worry about. The accounting majors, however, will get deeper into that in the intermediate sequence. But that's the cost principle. We report things at what they cost. All right. Revenue recognition principle. This says that we recognize revenue when it is earned. All right. It doesn't mean you've already collected the cash. And so, when is revenue earned? Well, the short answer is when the company has provided a good or a service. So just kind of stick a pin in that because it's going to be abstract until we get into chapters 3 and 4, and that's okay. But we'll come back to the revenue recognition principle. Expense recognition principle is very similar to the revenue recognition principle, but it relates to expenses. All right, so expenses are recognized when they are incurred. All right, and that's the expense principle, sometimes called the matching principle. And as an example, again, we'll get much deeper in subsequent chapters very soon. If I have a power bill, all right, that shows usage. I have a power bill from Duke Energy that shows usage for the month of August. All right, I don't have to pay that bill until the 20th of September. All right. However, I'm going to recognize at the end of August the amount of utility expense from the statement. Right? It doesn't matter that I haven't paid for it yet. The company has incurred an expense. It used power, and so for that reason, it has to record an expense. Right? It doesn't matter that the cash hasn't yet been sent to Duke Energy. All right. And so the next principle is full disclosure. All right. So, and I'll put up a set of financial statements in class. But if we look at financial statements, we'll see that there are 4 basic documents, and actually they're usually relatively simple. It's a income statement, balance sheet, statement of owner's equity, and the statement of cash flows. All right, so those are your 4 basic financial statements. But if we look, we'll see footnotes to the financial statements, and often the footnotes go for pages and pages and pages And that's because of the full disclosure principle. We'll look at some footnote disclosures and see the types of things that companies commonly have to disclose. But an extreme example would be, let's say a company has a catastrophic fire on January 2nd. This is a company that has a December 31 year end, fiscal year end, and on January 2nd, following the end of the fiscal year, they have a catastrophic fire and virtually all of the company's capability to generate income is destroyed. Well, none of that would be reflected in the actual financial statements because they reflect a period that ended before the catastrophic fire. However, not reporting the fire would be misleading. If you were a stockholder and didn't know about the fire, you would be very disappointed when you realize that the company no longer could generate money. So the company is going to have to disclose that shortly after the financial statement date, we had a catastrophic fire that destroyed substantially all of the company's ability to generate income or to generate revenue. And that's full disclosure. It's supposed to allow for a company to, I'm sorry, for external users to make full and clear decisions. All right. The accounting assumptions. So we have our going concern assumption. And this is simply assuming that the company will continue to operate into the foreseeable future. All right, that's the going concern assumption. The if we just assume that, right? Because we know that businesses can and do go out of business, but for the purposes of the financial statements, we're going to assume that the company will continue to operate into the foreseeable future. All right. Monetary unit assumption. All right. So this is quite simple. We express the results of operations in monetary units. It can be dollars, it can be Swiss francs, it can be euros, it can be the yen, it can be any currency. But it has to be, the results of operations are expressed in monetary units. For most of our purposes, it's going to be dollars. All right. Business entity assumption, which assumes that the business is separate from its owners and its accounting records are separate. So if the owner of a business pays rent, that should be from a personal account as opposed to a business account, right? We shouldn't see personal transactions in the records of businesses. And the time period assumption, so we assume that businesses operations can be divided into artificial time periods, namely months, quarters, and years. All right. And those are the periods for which we'll see financial statements. Every company issues annual financial statements. Public companies issue quarterly financial statements, and internally, most companies are going to produce monthly financial statements. All right. Quickly, we'll just discuss some constraints. All right. So in class, we will look at financial statements. And one of the things that you'll notice is that oftentimes the financial statements are presented in thousands. All right, if we look at Walmart, the financial statements are presented in thousands. What does that mean? Well, Walmart doesn't present numbers, I mean, they're rounded to the nearest thousand because, well, $100 is not material one way or another when making a decision as it relates to Walmart. All right, so it's not material, right? And you'll never see change on a financial statement for a large company. You're not going to see, $68 billion and 42 cents, right? Because the 42 cent is not material. It doesn't matter. All right, so that's an example of materiality. Cost benefit. All right, so as it relates to information and its reporting, only information that the cost to assemble and report on is going to be assembled and reported on. All right. There are some information, some transactions that are the cost of reporting on does not exceed their benefit. So that's the cost benefit constraint. All right. So those are your GAAP principles. We're getting close to the end of chapter 1, which is a fairly dense chapter in that it's more qualitative. But the accounting equation is something that we will see, we'll be working with really for the rest of the semester. All right. And so in double entry accounting, this must always be true. All right. So assets equal liabilities plus equity. All right. And if you want to think of an acronym, you can think of ALE, which is ALE, fancy word for beer. So anytime a transaction is recorded, it's going to affect one or more accounts. All right. And what we'll find in the chapter to come is it could be two asset accounts. It could be an asset and a liability, an asset and an equity. But before and after every single transaction, this equation must hold true. All right. Assets. What are assets? Assets are things of value to the company, things the company owns or controls. All right. Liabilities. Well, what are liabilities? Liabilities are things, amounts of money owed, are obligations of the company to third parties. So if a company has, an example I used just a few moments ago, the Duke Energy bill, right? It comes at the end of the month. It's not going to be paid until 20 days later. Well, that's a liability. That's what we call a payable. All right. Equity. So equity is the residual. It's the owner's claims against assets. So if we look at this equation, assets is on this side by itself. All right. So if we think of liabilities as the claims of third parties against assets, then equity is the claims of owners against assets. Another way to articulate that is if the company ceased doing business today, they'd obviously have to pay all the bills that were due, and whatever is left over, whatever money would be left over, would be the owners to keep, and that's equity. All right. Equity has a lot of component pieces that we'll see. We kind of see here contributed capital plus retained earnings. And real quickly, because we'll get deeper in this in chapter 2, contributed capital, if I'm an owner and I invest in the company, that's contributed capital. All right. Whereas retained earnings are the Well, as the name indicates, these are the earnings from prior periods. All right. Common stock is like investments in the company. Dividends are really money paid to common stockholders. That's also a component of equity. We talked briefly about the revenue, our revenue, when we discussed the revenue recognition principle. When a company does something, a company has sold a good or provided a service, that's a revenue. All right. And expenses are what the company incurs in the generation of revenue. So these expenses keep the lights on. Expenses help manufacture the products, and the difference between revenue and expenses is net income. All right. So that's a quick fly through. We'll dissect this further, so don't panic if that is still a bit abstract at the moment. All right. Last slide for chapter 1. We're going to talk about the 4 basic financial statements, 3 of which we're going to be preparing very soon. All right. Income statement, which demonstrates revenues earned over a period of time and expenses incurred during that same time. That's your income statement. Your basic format for your income statement is revenues less expenses gives you net income. All right. Statement of retained earnings. This is a roll forward. So when I say that, all that really means is we'll start with the balance at the beginning of a period. So if we have a company that has a 12/31 year end, that statement will start with the balance in the retained earnings account at 12/31. And actually, why am I saying 12/31? If we have a company that has a 12/31 year end, the beginning balance in retained earnings is going to be January 1st, i.e. the first day of business, right, in that year. And the ending balance is 12/31. So we'll see increases from net income to rate retained earnings, or decreases due to net loss or dividends paid. All right. The third is your balance sheet. All right. So your balance sheet is it's really the accounting equation personified. All right. So total assets, it's more of a snapshot. So both the income statement and the statement of retained earnings show change over a period of time, whereas the balance sheet is as of the last day of the accounting year. All right, or the accounting period if we're doing a quarter or a month. And at that date, we'll quantify total assets, all right, and we'll quantify total liabilities and total equity. And if we've done it right, they'll equal. So total assets would equal total liabilities and total equity. And again, still abstract. We're going to spend time in class constructing the balance sheet. All right. The last, which we'll get to towards the end of the term, is a statement of cash flows. Right. And so this will make more sense after chapters 3 and 4. But because of the revenue recognition principle and the matching principle, it is possible for a company to show net income and never generate positive cash flow. And companies are kind of like, cash to companies is kind of like blood to you or me. You can exist without it for a period of time, but not very long. So companies need to generate income, but they also need to generate positive cash flow. All right, and that's the statement of cash flows. It demonstrates whether the company is generating cash flow or not, positive cash flow or negative cash flow. And the reality is that companies can only generate negative cash flow, i.e. spending more cash than they have, for a period of time. Okay, so that's it for chapter 1.